Welcome to Woods of Stardon. This is CH. I will be covering the Lion-OCBC Securities Singapore Low Carbon ETF that has the SGX code ESG in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Amova Singapore Dividend Equity Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. The Lion-OCBC Securities Singapore Low Carbon ETF, as the name implies, appears to be a collaborated solution between Lion Global Investors and OCBC Securities. I, however, couldn't find any information of the specific role or involvement by OCBC Securities in the ETF webpage and documents, so I am not sure what exactly is OCBC Securities' contribution to the product. Lion Global Investors is a Singapore-based asset management business that was rebranded in 2008 from Lion Capital Management and is the result of the merger of the asset management businesses from OCBC and Great Eastern in 2005. OCBC is the second largest banking group in Singapore, while Great Eastern is the largest and oldest life insurance company in Singapore and Malaysia. Great Eastern and Lion Global Investors are both subsidiaries of OCBC. Lion Global Investors currently has about 74 billion Sing dollars of AUM, with core competencies in long-only mutual funds and ETFs across fixed income, equities, and multi-asset solutions. Given the nature of the setup, there is a notable tilt in the product offerings towards servicing OCBC retail banking business and the private banking business under the Bank of Singapore or BOS entity. Lion Global Investors also has several collaborations with other local and overseas financial firms to launch market or thematic focused products. OCBC Securities is a brokerage and trading business subsidiary of OCBC and was established since 1986. Its product coverage includes direct and derivative equities, bonds, futures, FX, and precious metals, as well as REITs and ETFs. The Lion-OCBC Securities Singapore Low Carbon ETF is set up as a Singapore standalone unit trust and is listed on the Singapore Exchange as an exchange-traded fund or ETF. The stock code for the primary trading currency Sing dollars is ESG as mentioned earlier. While the Lion-OCBC Securities Singapore Low Carbon ETF is a passive ETF tracking an index, and therefore fund managers play a less important role, the ETF prospectus does state Ng Kian Ping and Andrea Tan as the portfolio managers for the product. Interestingly, both of them are from the Multi-Asset Strategies team, and that makes me wonder why does Lion Global park this ETF under this team instead of its equities team? Perhaps it is because of Kian Ping's experience in ETFs, but it is nevertheless still a bit strange in terms of product categorization. The Lion-OCBC Securities Singapore Low Carbon ETF passively tracks the IH OCBC Singapore Low Carbon Select 40 CAP Index. This index is a bespoke index created in collaboration between SGX and OCBC, and is a subset of the IH Singapore Low Carbon Index created and launched by SGX under its SGX Indices business arm. It was launched in 2021 and has data backdated since 2011. The index is base currency in Sing dollars. Let's take a look at the broader IH Singapore Low Carbon Index first. The index looks at a universe of companies that are domiciled or incorporated in Singapore. While most of them would be listed on the Singapore Exchange, there is actually a pretty long list of countries that the companies can be listed in. As with how most indices are constructed, the index has liquidity requirements that include minimums for free float market capitalization, daily traded velocity, and daily traded value. There are two layers of exclusion criteria in the index. The first layer assigns a carbon intensity score and fossil fuel involvement range as evaluated by Sustainalytics, an ESG research firm with analysis services that is commonly used by a lot of ESG-focused investment solutions. Companies are excluded in this layer if they have no carbon intensity score or have 5% or more fossil fuel involvement. The second layer sorts the remaining companies by carbon intensity score, and up to 10% of companies with the highest scores are excluded. Constituents are weighted based on free float market cap, and the index has a standardized 7% weight capping. The index has about 58 constituents currently. The IH-OCBC Singapore Low Carbon Select 40 Cap Index, on the other hand, includes additional constraints and filters. For the eligible universe, the countries that the companies can be listed in are reduced significantly to allow only for Hong Kong and US, besides the obvious Singapore. The index also has additional exclusion screenings for controversial business activities and palm oil involvement. The index adopts a slightly different weight capping rule, with a max 10% for larger companies with at least $200 billion market cap, and max 8% for the rest. As the name of this index implies, it targets to have only 40 constituents, although there is a 10% buffer, which means the index can have up to 44 constituents. Lion Global Investors and OCBC Securities interestingly have their own web pages for this ETF, and with different documents available in their respective web pages. Here is an infographic found in the OCBC Securities webpage that summarizes the index construction process. So after the quick run-through of the two indices, the question investors would typically ask is, do the slight differences in the index rules lead to big differences in actual performance of the two indices? Here are the performance data from the index fact sheet. As it turns out, both indices have very similar returns, volatility, and drawdown numbers, with the broader IH Singapore Low Carbon Index having slightly higher returns and slightly higher volatility across nearly all time periods. As such, despite all the effort put in by SGX and OCBC, I don't really see much purpose to have two highly similar indices, as it might make more sense to collapse them into just a single index. As mentioned earlier, the Lion-OCBC Securities Singapore Low Carbon ETF passively tracks the IH-OCBC Singapore Low Carbon Select 40 Cap Index. It is clearly stated in the investment objective that the ETF uses a direct replication approach, although it can be a full replication or a representative sampling approach. This is further elaborated in the ETF prospectus that mentions the ETF may not be able to adopt a full replication approach due to various market liquidity constraints, in which case the ETF may invest in a subset of the index or may invest in other stocks not in the index but have a high correlation and similar market cap as the missing exposure. There is also a mention that the fund will not use derivatives for investment purposes. Given this is a pretty straightforward passive index tracker, there isn't much additional information available in the prospectus. I mentioned earlier that Lion Global Investors and OCBC Securities interestingly have their own web pages for this ETF. While they share the same top-level marketing tagline, the web pages provide rather different marketing sales points. Besides dividends being a common point, OCBC Securities stresses on the sustainability and low carbon aspects. Lion Global Investors, on the other hand, talks about performance and diversification and highlighting the underlying index used has an improved methodology. The so-called improvement or enhancement to the methodology is summarized here. Although I can't really agree on the improved part, since the index is still highly similar in performance to the broader IH Singapore Low Carbon Index. So all these changes have not really made a notable impact to investment returns. There are also differences in the documents provided. In general, the Lion Global Investors webpage should be where the investors should refer to. In fact, I found the fact sheet in OCBC Securities webpage outdated when I'm preparing this video. A much easier solution would be for OCBC Securities to just provide a link to the Lion Global Investors webpage, and I'm not sure why they are not doing this. The Lion-OCBC Securities Singapore Low Carbon ETF was incepted and listed in April 2022, giving it about 4 years of track record now. This is about a year after the underlying index was created. The ETF currently has an AUM of about 120 million Sing dollars, which is still quite small compared to the typical Singapore equity ETFs and funds in the market, so there is plenty of room to grow. One thing I don't like about Lion Global ETFs is that they like to provide underlying index portfolio data instead of actual ETF portfolio data, as there will be differences between the two. For this ETF, the webpage, brochure, and pitch book all use index-level data. The fact sheet is the only document I found with actual ETF portfolio breakdown data. I don't think it is that difficult to provide ETF portfolio data, and it would even be useful to compare the ETF versus index data so that investors know where the differences are. Here on the left is the index sector breakdown, and it is clear the intent is to highlight how different the index is versus the typical Straits Times Index and MSCI Singapore Index. This IH-OCBC Singapore Low Carbon Select 40 Cap Index clearly has much lower financial exposure in exchange for a more diversified spread, with notably higher exposures in real estate or REITs, consumer services, and technology. Looking at the ETF portfolio data in the fact sheet, we can see some notable differences in sector breakdown, though the classification methodology seems to be slightly different. Financials are even lower, but real estate and industrials are higher in the ETF. There is also a 8.36% consumer cyclical exposure versus 0% in the index. So I am not sure whether this is just a classification difference or if the ETF has taken some deliberate differences in the exposures. This is somewhat confusing, and again, it would be helpful to investors if Lion Global can provide a comparison between the ETF and the index. Country breakdown is missing in the fact sheet, so we can only look at index data here. The index has 12% in US and 10% in Hong Kong, which is a meaningful difference versus Straits Times Index and MSCI Singapore Index. This perhaps will impact the performance of the ETF, which we will go through later. As a low carbon focused solution, the ETF obviously will want to highlight its relatively lower carbon exposures in the portfolio, as expressed by what is termed as weighted average carbon intensity or WACI in this chart that compares against MSCI Singapore and Straits Times indices. One good thing about the ETF fact sheet is that it provides a full listing of the underlying holdings instead of just the top 10. The ETF is pretty top heavy, with top 10 totaling 67% of the portfolio. Given the Straits Times Index or STI is the most popular index to reference Singapore equity market, let's do a quick comparison of the ETF holdings versus the STI constituents. It turns out the differences are actually quite significant, with only 20 out of 30 STI constituents found in this ETF. This implies that the 10 missing STI constituents did not pass the screening processes of the IH-OCBC Singapore Low Carbon Select 40 Cap Index. Investors can use this information to have a think about which group of companies do you really want to invest in for a broad Singapore equity exposure. The Lion-OCBC Securities Singapore Low Carbon ETF has only one share class, but provides trading in the base currency Sing dollars as well as in US dollars. There is therefore only one ISIN, but two stock codes and Bloomberg tickers. The US dollar is simply a FX conversion on the Sing dollar price, and therefore it provides a currency unhedged performance in US dollar terms. Here are the performances of the ETF in both Sing dollar and US dollar trading terms. Again, the difference is the result of the FX movements of the Sing dollar to US dollar currency pair. The ETF charges a 0.4% management fee. Adding other expenses gives a total expense ratio or TER of around 0.45% per annum. Given this is a passive index tracking strategy, this means the ETF should generally deliver a return that is around 0.45% lower than the index. This fee level is similar to other ETFs offered by Lion-Global, although it is considered on the slightly higher side compared to other Singapore equity ETFs in the market. Lion-Global doesn't provide much trading data for the ETF except for tracking error indicated in its webpage. The ETF currently has a tracking difference of minus 0.52% and tracking error of nearly 0.24%. That sounds acceptable when we factor in the TER. Based on performance data in the fact sheet, the ETF is lagging the benchmark by about 0.6% per annum. The Lion-OCBC Securities Singapore Low Carbon ETF provides a semi-annual distribution payout, as per stated in its webpage and fact sheet. Distribution data is found in a separate Excel file that covers all the Lion-Global funds. From the data available, we can see that the distribution amounts have been fluctuating and increasing over the years. There are also additional special dividends distributed out in late 2024 and late 2025. This results in a really high distribution yield of about 6.4% in the past 12 months. However, as we can see, the underlying portfolio yield is only about 3%. So it is a concern that the ETF is paying out a much higher distribution yield than what it seems to be able to generate. Interestingly, the ETF prospectus also states that it intends to have only a distribution yield of about 3 to 4%. Given this ETF doesn't have a high distribution payout objective, I don't really understand why it has decided to increase its distribution payout instead of keeping the excess in its capital for long-term compounding growth. Here is the NAV versus total return chart of the ETF since inception. We can see the increase in the gap in the past year or so, especially since the special dividends were introduced. Investors who don't really need such high distribution payouts and believe in the long-term growth potential of the ETF should consider reinvesting the excess distributions. The Lion-OCBC Securities Singapore Low Carbon ETF was incepted in 2022, so it has only about 4 years of track record. Performance data as shown earlier is available in the ETF fact sheet. Given the Singapore equity market has had a strong bull run in the past 2 years, all the return numbers look good here. However, we should really compare the ETF with other generic Singapore equity ETFs and funds to see if it is worthwhile going for this low carbon strategy. The ETF pitch book has nicely done some performance comparisons versus Spider Straits Times Index ETF, Amuva Singapore STI ETF, and Xtrackers MSCI Singapore UCITS ETF. Based on the data shown, the Lion-OCBC Securities Singapore Low Carbon ETF outperformed the STI ETFs in 2023 and 2024, but underperformed in 2025 and year to date. It also appears to be more correlated to the Xtrackers MSCI Singapore UCITS ETF performance-wise. This is mainly due to the differences in the portfolio constructs, whereby the Lion-OCBC Securities Singapore Low Carbon ETF and Xtrackers MSCI Singapore UCITS ETF have a larger number of holdings, of which some are companies listed outside Singapore. SEA Limited, for example, is a 6 to 7% position in the two ETFs, but absent in the STI ETFs. Given its large exposure, it has partly attributed to the better returns in 2024, but worse returns in 2025 and year to date. On the other hand, the much higher financial sector exposure, particularly in DBS and OCBC, in the STI ETFs, have led to better performance in 2025 and year to date. That being said, when we put the ETFs together, we can see that the performance differences were not significant throughout the years, and the big gap really happened only from start of 2026. We can therefore get some observations from these charts. The first observation is that the low carbon strategy, as per defined by the underlying index, that is the IH-OCBC Singapore Low Carbon Select 40 CAP Index, did not really translate into a better performance over time, despite ESG advocates promoting the idea of companies with better ESG indicators lead to better investor outcomes. However, the ETF also did not end up with a worse performance from 2022 to 2025, showing there is some value in the screening process, leading to a slightly different portfolio of stocks that had held up decently well. The second observation is that the rather large performance differences year to date shows that the ETF movements are heavily influenced by the few large cap market leaders. The STI ETFs are doing better year to date, mainly due to its much larger exposure to DBS and OCBC. The Lion-OCBC Securities Singapore Low Carbon ETF, on the other hand, has been dragged down by SEA Limited, one of its top holdings that is absent in the STI ETFs. The third observation is that if we leave the STI ETFs aside, we can see that the Lion-OCBC Securities Singapore Low Carbon ETF has been a better performer than the Xtrackers MSCI Singapore UCITS ETF. So between these two ETFs, investors can see a clearer winner. There is unfortunately no single best solution in the market. Investors who have been advocates of the STI ETFs would be happy to see the ETFs continue to run up strongly, but would need to remind themselves that about half of the portfolio is in the three local banks, so it is a very sector-concentrated play. Investors who like the low carbon or ESG story and are looking for a more sector-diversified portfolio may instead find the Lion-OCBC Securities Singapore Low Carbon ETF an interesting proposition. With that, let's summarize our findings. Lion Global Investors is an asset management business under OCBC. While the overall AUM doesn't look too big, it does get ample support from the wider OCBC businesses. While OCBC Securities look to be a co-partner in this product based on the product name, there is no mention of its involvement at all in the ETF webpage and documents. This is a straightforward solution that is a passive indexing ETF tracking the IH-OCBC Singapore Low Carbon Select 40 CAP Index using mainly a direct replication strategy. The index is a subset of the broader IH Singapore Low Carbon Index that appears to be customized by OCBC with additional screening requirements and slightly different parameters, possibly designed specifically for this ETF. Consequently, the Lion-OCBC Securities Singapore Low Carbon ETF is an investment solution catered for investors interested in the low carbon and ESG theme, while wanting to invest in a broad Singapore equity portfolio. The ETF was incepted about 4 years ago. but still has a relatively small AUM of about 120 million Sing dollars only. One thing I don't like is that the ETF webpage and most of its documents show the breakdown data by the index portfolio instead of actual ETF portfolio. Only the ETF factsheet has the actual portfolio data available. The ETF has a portfolio with some notable differences versus the Straits Times Index, or STI, that is most commonly used by investors to represent Singapore equity markets. While the ETF provides better sector diversification, it is also missing some familiar local names as a result of the screening process in the underlying index. Investors should therefore have a look at the holdings list and compare against the STI ETFs to see which portfolio appeals more to individual preferences. The ETF has exhibited a decent performance since incepting in 2022 to end 2025, delivering a similar return as the STI ETFs. Performance in 2026 year-to-date has, however, been disappointing. This is mainly due to lower exposures in DBS and OCBC, as well as poor performance of some of the other exposures, such as SEA Limited. In conclusion, the Lion-OCBC Securities Singapore Low Carbon ETF is an interesting proposition for investors looking for low carbon or ESG theme in a broad Singapore equity exposure. This will, however, be a year that challenges the concept of the low carbon strategy and sector diversification in the ETF. So it will be interesting to see how the ETF performs versus STI ETFs through the year. This concludes my absolutely biased comments on the Lion-OCBC Securities Singapore Low Carbon ETF that has the SGX code ESG, and I hope it will help in your investment journey. May we all grow wiser and prosper.